Good morning, everyone, and welcome. And on behalf of the Ortencio Group, we'd like to wish all of you a Happy New Year. As a reminder, this call is being recorded. As always, I have with me Gareth Watson, Vice President in Investment Management and Research at Richardson GMP. For those new to the call, Gareth's been a regular guest on BNN and has been co-host several times on the Lang & O'Leary Exchange. He's also been a resource for all the major business publications such as Globe and Mail and the Financial Post. The presentation is going to last about 20 minutes. As the invitation states, we will provide our outlook for 2013. Gareth will present his views on Europe. How big of a problem is it, or is it old news? The U.S. is the big economic powerhouse finally waking up. In China, what should we expect? And of course, how this all ties to Canada, and more importantly, how we will position our portfolios based on what we anticipate. But before I hand it over to Gareth, I want to recap what happened last year. We saw the re-election of President Barack Obama in 2012, and the big news at the end of the year was the U.S. fiscal cliff, and as anticipated, the U.S. averted the so-called fiscal cliff. On the major stock market indices, in 2012, the TSX was up 4%. The first 2 weeks, actually, of 2013, the TSX is up 1.4%. The S&P 500 was up 10.4%. Year to date, the first 2 weeks is up to 3.1%. The MSCI Europe, Australia, Far East, which is basically the indices for non-North American stock market index, 10.6% in 2012 and 3.1 year to date. So you can see that investors who are not diversified outside of Canada, their portfolio would have lagged against all the other indices. In fact, our in-house cornerstone dividend portfolio was up 13.37%, handily outperforming the TSX. Fortunately, our philosophy of diversification using asset allocation has kept us invested in markets outside of Canada. And you'll see when I sit down with each one of you this year that your portfolios will generally have outperformed the TSX in 2012. My last remark before I hand it over to Gareth is that we feel positive going into 2013, much more so than last year going into 2012. I'm sure he'll echo his sentiment and provide us with what to look out for throughout the year. So I'm going to pass it over to Gareth. Gareth, welcome, and thanks again for presenting to our clients.
Great, thanks Frank, and Happy New Year to you all. As Frank mentioned, I'll probably be about 10 to 15 minutes here in terms of my comments today out of respect for your time, in trying to give you as succinct and precise a forecast as I can for the upcoming year in 2013. I'll first of all start off by echoing Frank's comments here in terms of our expectations for 2013. We do feel better moving into this year than we did last year in terms of our outlook. It's not to say that we have expectations for a year of considerable gains for the stock market, but considering what we were facing going into 2012, admittedly still facing some of those risks and unknowns, we do feel better about the global situation at this stage, and perhaps you'll have a better understanding why when I conclude my remarks here. For those of you that have seen or heard me before on these WebEx presentations, you know that I tend to follow a certain format in my presentation, and today is no different. Looking from the high level, so to speak here, I'm just going to touch on a couple of things. Number one, as I said, there was a few unknowns last year. Europe, obviously, with respect to financing, China with respect to their economic growth, and the United States with just so many things unknown, but predominantly the fiscal policy and well, one could call it the silliness of Washington and how much that has really held back the U.S. recovery. I'm just going to touch briefly here on Europe, and the one thing that I want to emphasize about Europe, last year we spent most of the beginning of the year trying to figure out, which countries were going to survive. If you had read the press and watched TV, you certainly got the feeling that the euro as a currency was about to be obliterated, that countries left, right, and center were about to go bankrupt. There was a lot of fear in the market, and a lot of that fear was based on the fact that borrowing costs for many of what we call the periphery nations, and many of you are familiar with the situation in Greece and Italy, Spain, France, or sorry, not France, Greece, Ireland, Italy, Portugal, and Spain. I mean, France has their own problems. Don't get me wrong. They're not in the clear either. But certainly the periphery nations saw escalations in their borrowing costs, as you can see on this chart, the 10-year sovereign bond yields. The fortunate thing that happened, and I think this was a real turning point for the markets last year, not to underestimate the significance of this, mainly because it was so simplistic, and that was the European Central Bank coming out basically saying, look, we're going to do whatever it takes to make sure that borrowing costs are low and that we preserve the euro currency as it currently stands and the eurozone as it currently stands. And you might think, well, that's just a lot of talk, a lot of words, but it was actually the first time during all this process, particularly with Greece for the past 2 or 3 years, that the European Central Bank actually came out and said that. And the funny thing is, even though they've said this and they set up a program for countries to help get their borrowing costs low, the program would only be put in place if countries actually signed up for it. And so far as I know, not many countries, no countries have really signed up for the program. It's just that the belief that the European Central Bank would be there to back these nations alone sent borrowing costs lower. And the good news is now that I wouldn't say that the current yields for these countries are excessively sustainable for an extended period of time, but they are back at a level which are manageable in the short term, and more importantly, which will give these countries, buy them more time to get their fiscal house in order. So we do feel more comfortable, albeit not completely comfortable, with the situation in Europe when it comes to sovereign financing. With respect to China, our argument has always been that China is a country in transition, that yes, there was obviously a decline in a lot of economic data last year, which was not surprising considering that Europe and the United States are their 2 largest customers. And with Europe struggling as much as it did in particular, it was really hard to expect China's economy to grow, and for the world economy, for that matter, to grow, as Europe has the largest economy on the planet as a continent. The situation in China, we believe, seems to be showing some signs of stability, that the decline in the data that we had been seeing has started to level off, and we think potentially we are seeing a bit of a bottoming out here on this current cycle downwards, which potentially could be setting China up for growth in 2013. And now when I say growth, yes, they're going to grow. Everyone knows they're going to grow in 2013, but I should say it at an increasing rate compared to 2012. They have some tools at their disposal. We have had a transition of power there that happens once a decade. It is now complete, so we think that the country is now more willing to put policies to work to get the economy going. And if you see an improvement in any way, shape, or form in Europe and the United States, it only helps China. Now, Europe is in recession. We believe that they will come out of recession towards the end of 2013. That only is a good thing for China. And the same thing with the United States, not that they're in a recession, but we think that we could see a pickup in growth as we go throughout the year, again, adding to some momentum, hopefully, over in China, and that, of course, translates through into the commodity markets, which is a good thing for Canadian markets as well. The United States, the Federal Reserve has done what it can. So let's stop looking towards Ben Bernanke for help. The guy has done what he can. The Federal Reserve has done what they can. It is now in the hands of politicians to really start getting their act together, start putting policies in place that help create jobs, and putting Americans back to work, putting income in their pockets so they can go out and spend, and we can start to see a rejuvenation in the American economy. Now, it's true that economic growth there, they have been growing, but admittedly also they haven't necessarily been growing at an increasing rate over time. It seems to be somewhere on averaging around the 2% level, and we need to see that pick up. We haven't had the traditional expansion out of the last recession in 2008 for many reasons, mainly because we not only had a cyclical recession, but we had a structural collapse of the financial system. But we really do need to see some type of acceleration to hopefully create more jobs. Job creation, yes, it has existed for the past 30 months. That is a claim certainly that President Obama can make. But when you lose 8.75 million jobs during the recession, you've probably gained back about close to 5 million of them. That's just over halfway in terms of getting the jobs back, and we are now 4 years after the actual collapse. That is a long time, and by now, normally during an expansion, we would have recovered all the jobs. And if you look at Canada, we've recovered all the jobs we lost during the recession. Americans aren't even close. So job creation is going to be very key. The good news, of course, here, again, they are creating jobs. The bad news is not as quickly as we'd like. We'd like to see more of them. And again, the more Americans you can put back to work and put incomes in their pocket, the more consumption that there is, the more consumer confidence that there is, and that's also going to help housing. Now, since 2008, when the market really collapsed, and the U.S. housing market actually started to fall in 2007. Nobody noticed, though, because the stock market was doing so well up until September of 2008. But the collapse of the housing market since then, I have probably heard at least 9 or 10 times that the U.S. housing market has bottomed and that the declines are over. And every single time I heard that, it was wrong. When I look now at the current state of the housing market in the United States, I think I can conclude we're feeling pretty good that, in fact, we have now seen a bottom on the U.S. housing market when it comes to pricing. Admittedly, who knows in terms of volume sales, but we don't care about volumes as much as we do about price, because price determines the value of the asset. Price is basically reflective of wealth, and if prices are going up, wealth is going up, which of course lends itself more to consumer spending and consumer confidence. So a recovery in the housing market is very key here for the U.S. economy, and I think that we might be seeing some early signs that it is starting to recover, albeit very slowly. I'm not expecting some type of rapid recovery, but any direction up is good direction. Monetary policy, the Federal Reserve, bluntly put, they have said, look, don't expect rate hikes anytime soon. You're not going to see them in 2013. You may not even see them in 2014. They have recently introduced a 6.5 unemployment rate as a trigger rate for raising rates. Don't exactly agree with that. I think they're kind of pigeonholing themselves and reducing their flexibility, but considering that they're at 7.8, 7.9 right now, a long way off in terms of hitting that trigger of 6.5%. Rates are going to be lower for longer. Get used to it. You probably already are, because we've had them so low for so long in the United States. And again, our expectation here is that rate hikes, not this year, maybe not next year, but likely more into 2015. It is possible that expectation gets brought back into 2014. It will depend highly on the recovery here over the next 12 months. Canada, we continue to reduce the federal deficit, albeit we're probably a little bit behind schedule on the original plan of getting back to a balanced budget that the Conservatives put out, but we are reducing the deficit nonetheless, which most G7 countries, in fact, I think we're the only G7 country that can actually say that we are doing that. Jobs have been surprisingly strong. The past 2 job reports have been much better than expected, so I don't necessarily see that momentum continuing. But you know, in terms of our outlook here, GDP growth hasn't been tremendously great in Canada. It has been relatively small. It's nothing to write home about, so I don't want people to feel too overconfident about the outlook for Canada. We still have some work here to do. Our trading partners are still struggling to a degree, and that is going to impact us. And as such, we don't expect to see rates in Canada go higher this year. At the very earliest, you might see a rate hike at the end of 2013 if things are better than expected. But on the whole, we're not expecting rate hikes, mainly also because inflation is certainly not going to be a trigger to raise rates. It's quite benign at the moment. The biggest threat, though, to the Canadian economy over the next 5 years has to be consumer debt. To a lesser degree, the housing market. Simply put, when rates go higher, there's going to be a lot of Canadians that are prepared for it, but there's also going to be a lot of Canadians that are not prepared for it. Some people believe that a 1% increase in interest rates means your mortgage payments go up 1%. That is not the case. That is a function of education that we need to push harder and make sure that Canadians are informed as to what their sensitivity and what the impact would be to rate increases in this country. I'm speaking probably more to the younger generation. The baby boomers have likely already paid off their homes. They already paid off their mortgages. They probably have a little debt relative to their incoming cash flows. So they are not the problem. It is the younger generation where that might be a completely different story, and it does tend to be the younger generations that are the ones that consume more than the older generations. And so this could be a problem down the road for the Canadian economy, and I'm thinking 2014, 2015, when rates start to actually move higher. You may not see the impact immediately because we're not moving rates higher right now, but I'm hoping that Canadians will be a bit more proactive on their personal finances instead of reactive, because if they are reactive, then we're in a bit of trouble. As I said, the impact will probably not be felt in 2013. The same thing goes for the housing market. I always get the question about the housing market. Are we a bubble that's about to burst in this country? At this stage, I say no, because as long as rates are low, I think people still borrow. They're doing a very good job and have been doing a very good job for quite a while, borrowing money at low rates. And as such, I don't think that necessarily continues until rates go higher, at which point I think you will then see further pressure down on prices in the Canadian housing market. But I don't expect a collapse, and my expectation for pricing is not one of a huge decline in 2013. But once we start seeing higher rates going into 2014, 2015, that could be a different story. Looking at commodities, just very briefly, it was a good year in 2012 for commodity prices. On the whole, the winners were definitely agriculture and precious metals. The losers, to a little bit more of a degree, was oil. Normally, we expect to see oil prices up in Canada. Did not happen last year. These are U.S. priced, actually, West Texas Intermediate. And the base metals were a bit of a mixed bag. But on the whole, my point here is that normally, in good years with commodities that we're used to seeing in the past, all commodities across the spectrum tend to do well. Last year, we saw a bit more mixed performance. When we look forward to 2013, on oil, our expectation is probably about a fundamental floor of around $80 per barrel. We think oil will trade, fundamentally speaking, between $80 and $100. It could easily exceed $100 if there are geopolitical events or things that we simply can't forecast that would influence oil prices. For example, this is completely hypothetical, but Israel drops a missile on Iran. That could definitely put oil up to $110, $120 a barrel in no time. But just based on fundamentals alone, on supply and demand, in terms of what the globe is looking to use, where the global economy currently is, we think that somewhere between $80 to $100 in 2013 is realistic and should be expected. On average, of course, around $90. But potentially more downside than there is upside, just based on fundamentals. We actually hope that oil prices do stay closer to that $80 per barrel level, mainly because it only helps the global recovery. Lower energy or input costs always benefit a recovery. So we do want to see some benefit to our friends in the West because of the dependency of Western economies in Canada on the oil patch. But we also want to see benefits to the global economy, so we need to find a nice fine line between the two where both benefit. And certainly going above $100 on a sustainable basis is not going to help. Now, natural gas, on the other hand, we're still bearish on it this year. We don't necessarily see any changes in the fundamentals. Lots of supply, tons of supply. If anything, the weather here recently in Ontario would indicate that there might not be a huge demand for heating with natural gas. Who knows? Now that I've said that, we're probably going to go to -30 overnight. But my point being is that we've not had the type of demand that we have seasonally in the past on natural gas for heating in the Northeast. And, you know, just simply put, the Americans and the Canadians have more gas, I think, than they know what to do with. And so I don't necessarily see any upward pressure on pricing this year. Base and precious metals. The base metals, our arguments here are based more on our outlook for China. And we feel that if China can improve, then base metals should be able to find support at current levels and potentially provide you with positive returns in 2013. On the gold front, we have a different story this year. We've been bullish for the past couple of years, mainly because of monetary policy, with a lot of money being put into the system, lots of quantitative easing, lots of bond purchase programs. Those are the types of things that tend to increase money supply, therefore decrease the value of each dollar that's put out there. And as such, U.S.-denominated commodities, U.S. dollar-denominated commodities tend to go up, and also there's always concerns about inflation. People flock to gold. We don't think the argument is as strong as it used to be when it comes to gold prices, mainly because a lot of the monetary policy, the quantitative easing that has happened over the past few years, it's been getting smaller in size as we move along. So we had QE1, we had QE2, we had QE3 last year. QE3 was smaller than QE2, and there's a lot of discussion recently, too, of course, that the Federal Reserve could start to wind up some of these programs as we get closer to the end of 2013. So as such, we're not as bullish on gold as we once were. We admit there might be some trading opportunities this year to make some money in 2013, but purely based on longer-term fundamentals, we are much more neutral on gold as an investment. Looking at agriculture, it was just a rock star year last year, and it's sad to say this, but it's because there was drought. Agriculture, whether you're looking at wheat, corn, soybeans, if you're looking at agricultural stocks, if you're looking at fertilizers, they do well, unfortunately, when things are bad. And the drought that we saw in the U.S. Midwest, which actually is even still persisting today, it's still quite dry. In certain parts of the Midwest, even though it's winter, we're not focusing as much on it because the harvests are done and no one's planting anything in these weather conditions. But you still need that moisture. And right now it's still relatively dry, and that's probably why pricing has held up reasonably well amongst the commodities. It's very tough to make a forecast on this, and quite frankly, I think you need to have more of a degree in science than a degree in finance to forecast agriculture. Our expectation, though, is if current conditions persist, there should be continued support for pricing. There could be some downward pressure on prices if, in fact, we do have great planting conditions and we get a lot of rain in the spring. So just keep that in mind. You're looking at planting conditions and you're looking at weather. When it comes to investments in the sector, they always remain quite volatile because of that. And finally here, the Canadian dollar, my last comment for the day. Looking at 2013, well, in fact, let's look at 2012. Our expectation was that we were going to hover around parity for the year. Nothing was going to take us significantly higher. Nothing was going to take us significantly lower. And on average, that's basically what happened. For the most part, we traded around parity. We think that persists into the first part of 2013. Which one will outperform the other, the Canadian dollar or the U.S. dollar this year? We tend to lean more towards an outperformance of the U.S. dollar over the Canadian dollar, and that is because if, in fact, well, first of all, we think that there's more leverage to a U.S. recovery. They got hit harder than we did. Our economy does not have the momentum potential that the American economy does. And if they start to get some things right in the U.S., even though the first quarter is going to be very tricky with a lot of volatility to do this debt ceiling debate, on the whole, we think that the U.S. dollar has the potential to outperform because lots of investors could return to the U.S. dollar, which they abandoned on the way down. And as such, fund flows alone could help the U.S. dollar outperform the loonie, which means that we could go briefly below, or we could go below parity again. But fundamentally speaking, I think that if the U.S. is doing well, that actually bodes well for the Canadian stock market. It bodes well for commodities. So any of that fund flow strength could potentially be offset by fundamental strength in the Canadian economy. So my whole point being here is that even though it's possible that the U.S. dollar will outperform the Canadian dollar, and the Canadian dollar goes below parity, that it will not plunge below parity, and that it will stay relatively close to parity on either side of parity for 2013. We don't see any big, huge swings coming in the near future. So if I had to really throw it out there, I'd say on average you're going to be at parity. I lean a little bit more towards the U.S. dollar in terms of strength. And where I could be wrong, again, is if the U.S. economy does way better than expected, commodity prices get a tremendous amount of support because the global economy starts to hum again towards the end of 2013, in which case the Canadian dollar will have a chance to outperform. So with that, those conclude my remarks for today with respect to our outlook for 2013. And with that, I'll pass it back to Frank.
Sure. Just one question for Gareth here. Is it safe to say that China has experienced a soft landing based on the numbers that have come out, or is it too early to tell at this point?
Well, it's always it's a great question, mainly because the first question you have to ask is, what are the real numbers in China? And you have to take some of these numbers with a grain of salt. They're not as, what can I say it in a very politically correct way, they're not as clean as sometimes people believe that they actually are. But on the whole, just looking at things such as inflation, such as GDP growth, such as retail sales, it would appear as though you could label this as a soft landing. I think if it was a hard landing, we'd be talking a heck of a lot more about China right now than we currently are. It's not to say that they have landed. I think we still need to see a couple more months of data to confirm some of the data that's been released recently. Certainly never make a conclusion based on 1 month data alone. I think you need to look at least 3 or 4 months to see if there is a trend starting to take hold. But from what we've seen in the data so far, it would appear as though I would probably label it as a soft landing.
Okay. And Canada, as per usual, how is our economy dependent on China, U.S., and in Europe, and how important is it that they do well, that we will do well?
It's important that all three do well, but for different reasons. When it comes to our economy, there really is only one country that we pay attention to, and that is the United States of America. We do 75% of our trade, and those numbers vary from year to year, but approximately 75 to 80% of our trade with that country. So, you know, as goes the U.S., so goes Canada. We do, though, care about China. We might not do a lot of trade with China, but we care about them because their demand recently, especially in base metals, has set the expectations for pricing on commodities. And we are a resource-based economy. Admittedly, manufacturing has used to be at the forefront when the loonie was at 63 cents, and now commodities have taken the forefront. And as such, as a commodity-related economy, even though you might not do direct trade with economic powerhouses out there like China, they do set the tone for commodity pricing, and therefore we do care about what's happening there. So we do want them to do well. Europe, it's a whole level of interconnectivity and interrelationships that would explain this, but we do about 10% of our trade, if that, with Europe. So you might think, who cares? You know, if they're in a recession, it doesn't really matter to us that much. But it does matter because Europe is China's largest partner. And if Europe is hurting, then China hurts. And if the United States is hurting, then China hurts. And if China hurts, then Canada hurts. So you can draw the four different parts of the world, and you can basically draw a line between each one of them because there is a relationship there. We as Canadians care about all three, but for different reasons. U.S. is for direct economic dependence. China is based on their reliance on resources and the impact it has in this country. And Europe, of course, is, again, an extension of that relationship. We care about Europe because China cares about Europe and because we care about China.
Okay, great. One last question. U.S. debt ceiling, is this a solvable issue?
Yeah. They could solve it today. They could raise the debt ceiling today, and that's not going to happen. It is a concern, though. The debt ceiling was a bigger concern for us than the fiscal cliff, which ended up being a bit of a joke, really. You know, everyone thinks that they solved the problem. They didn't solve the problem at all. In fact, they made the problem worse, and they didn't really solve the issues that needed to be addressed, namely on spending. They addressed tax policy, and in a process where they were trying to reduce the deficit, according to the budget office, they've actually ended up increasing the deficit with the deal that they came to. But the whole point here is that the debt ceiling, the impact if they had gone over the cliff for an extended period of time, likely wouldn't have been felt by the average American immediately. They would have seen some deductions on their payroll. In fact, they already are seeing deductions on their payroll taxes. Those tax holidays have expired. But in other ways, they probably wouldn't have seen the impact on their wallet immediately. If the debt ceiling is not raised and it eventually leads, whether it be in February or March, to an actual shutdown of the U.S. government, you will see an immediate impact on the U.S. economy. That's bad news, and we can't have that happen. I personally don't believe that the Republicans can afford to let the government shut down right now. They have a number of issues in Washington to deal with, internal as well, and it would not be, I think, good politics for them to let that happen. So at some point, there's going to have to be some type of consensus. The stance that the president's taking is, I'm not even going to address spending right now. It's you raise the debt ceiling or you don't, and we'll deal with the spending later. But he can't really say that because this whole delay of sequestration that happened with the fiscal cliff is going to expire in March. So all these things are starting to happen at the same time, and at some point there is going to have to be a deal or else the U.S. government shuts down. And I just don't necessarily see that being to the benefit of either political party, politically speaking. Forgetting the economics and financials, it all comes down to politics at the end of the day, and I don't think it's good for either party for them to let that happen.
Great. Well, thank you, Gareth, for the valuable insights. As mentioned, we remain positive for 2013. Keep in mind that there will be issues that will continue to provide food for volatility, but that's something that we have been used to over the last couple, if not many years. Before I go, I just wanted to present a little interesting tidbit. According to the Trader's Almanac, over the last 40 years, when the first 5 days on the S&P 500 is positive, there has been a gain that year 85% of the time, which is 34 of the last 40 years, with an average return of 13.6%. So the first 5 days of 2013, the S&P 500 has delivered a 2.2% gain. So just interesting. History on our side at this point is on our side based on 2013. I look forward to seeing everyone personally in the next couple of months to review your own portfolios. And please expect our next webinar in the second quarter. Thank you, and have a great day.